These guys are going to be living off $100,000 a year in retirement and only paying $2,000 in taxes. That's it. An effective tax rate of 2%. You know, pretty easy to do. They don't have $1,000,000 either, by the way. I'm just going to show you how it works. It's actually quite simple. You can do it too if you only knew how to work Social Security. And a lot of people don't. They discount Social Security. The cultist, the anti-Social Security cultists, they say, Social Security's going bankrupt. They'll never be there. Blah, 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 blah. Social Security, they tax you twice. All this is crazy, man. Crazy. They don't understand how it works. And of course, if you're fearful, you're ignorant, you become if you're ignorant, you become fearful. And that's what happens. I'm ignorant of Social Security, so I become fearful. It's like the Fauci cultist. I'm ignorant of actually the science, so I'm going to just follow what Fauci says. If Fauci tells me to get 25,000 Maxine Waters, I'm going to do it because that's the science. Watch how many people say, I can't believe you're talking about Dr. Fauci that way. You should be thrown in jail. I get so many people, the Fauci cultist is nuts. All right, so let's go in there. So what we're going to see here is these guys are living off, their expenses are $50,000 a year, all right, adjusted for inflation. For basically $3,500 a month in living expense, $3,000 in property tax and homeowners insurance, and right now is $6,900 in healthcare. The reason healthcare is so low is because she is on Medicare, but he's going to be on Obamacare, and because they don't make that much income, that he's going to get quite a lot of subsidies in that. Now, once he is on Medicare right here, his health insurance, their health costs will go to $1,000 a month because Medicare ain't cheap. It's certainly not free. AOC and all you idiots out there say, we need a big health care for all, Medicare for all. Where's the money come from? It's already expensive, fools. But let's talk about Social Security. Crazy. $1,000 a month on health care is what we're talking about once they hit 65 years old, both. So they're going to spend $3,500 a month adjusted for a 2% inflation, which I use because that's what the Federal Reserve target is. We got housing adjusted for a 3% inflation, and we got Medicare adjusted for a 5.5% inflation. So $50,000, $60,000, and as they go forward, it'll be about $70,000 for their expenses. All right, so hang tight. All right, so the question is, where does this expenses come from? Well, we got Mrs. She has Social Security. She took it at 62, and because she was a house mom, she didn't make a whole lot of money, so she's getting $4,700 a month in Social Security. Plus, we're going to pull $50,000 a year from his portfolio, so we're just for his IRA. So we're going to say $50,000 from his IRA, basically $5,000 from her Social Security. The 831 in there is just the HSA. The software makes you take the HSA. I wish they did not, but it doesn't matter. So you got $55,000 of income, which covers $52,000 of expenses. But this $52,000 expenses does not include the taxes they have to pay. So we have total expenses of $5,600, in which case they'll have to tap into their checking account to cover the rest. So $56,000 of expenses, $55,623 of income. They're going to have a shortfall of $878. They can easily tap into their savings account. And we're going to do this. So he retired at the end of this year, 2021. So 2022, 23, 24, 25, 26, 27. We're going to do that for 6 years. So they're going to take $300,000 out of a portfolio that's only worth $750,000. No big deal. Then his first full year of Social Security is going to be right here at 68 years old. That's his first full year of Social Security. So he'll have her Social Security and his Social Security. Her Social Security will also get a bump up. Why? Because she has a spousal benefit. So when he files at 68, he'll file at 67, his first full year, but he'll be opening up another $10,000, if not $11,000 a year for her. So they're going to have $56,000 a year of Social Security. All right, right here. I want to go to the first full year, 2029. Their income is their expense is only $65,000. All right, hold on a second. You got $56,000 of income from Social Security. $64,000 is their expenses. Again, pretty much all the same stuff as before. So they'll need to dip into their IRA or their portfolio of some regard of $8,000 a year. So they have $66,000 as outflow, $5,500 a month, no tax. Isn't that interesting? No tax. Why is there no tax? Because if Social Security is your only income, you pay no tax. In this case, Social Security isn't their only income. They still need $8,000 from their 401k or IRA in which to cover the rest of it, and yet they still got no tax. Oh, by the way, here in 2022, they're selling their house that they're in right now for $150,000. They're going to buy another house they're buying a camper and another house, all inclusive could be about $250,000 or so. So they're gonna have to come into their checking account for $100,000 to clear these two things. So basically what's happening is they're saying, look, we're gonna spend $261 on another house and a camper. It's going to cost us $261,000. We don't have $261,000 coming in of income, so we're going to go into our portfolio, in this case, just their cash account, and clean out $103,000 to cover that expense. But we are going to get $157,000 from the sale, so we just need $100,000 to cover it. All right, hope this makes sense. So hang tight. Their 1040, we're going to see they have $50,000 IRA distribution. This is in 2022, next year. $4,600 of Social Security. All right. Of that, which is $3,900 is taxable. So $4,600 is their total take-home Social Security, plus their $50,000 of IRA distributions, plus they'll get some taxable interest. So all said and done, their AGI is $54,928. You take away your standard deduction of $26,000, and what's happening here is your taxable income is $28,000. So they're paying a $3,000 income tax on basically $55,000. All right, it's still a little bit more than a 6% effective tax rate. Not too shabby if I do say so myself. So let's keep going. Now we hit required distributions. So my man's 72, wifey's 76. They have income flows from Social Security of $62,000 a year. And again, that's 12 years from now. So it's inflating at a 2.4% rate return, rate of cost of COLA. Their IRA RMDs are $25,000. All right, so they got $87,000 of income. $87,000 of income. Their expenses are only what? $67,000. So they have $67,000 of expenses plus a little bit of taxes. Their total outflows are $68,000. They get $87,000 coming in. Their taxes are $1,200. If we fast forward to right here, their RMDs get bigger. 30,000 RMDs. Social Security $70,000. Their expenses are gone up because, again, we're inflating healthcare at 5.5%. That's one of their biggest expenses. Their expenses right here are $78,000. They got $100,000 coming in, $2,000 in taxes. So let's take a look at the 1040, shall we? Because this is amazing. All right, so here's their 1040 for 2038. And my man was like, as everybody does, he thought 85% of his Social Security is going to be subject to taxes. So when he was doing his Excel spreadsheets, it was off. And the reason it was off because he's given himself much more taxes than was actually going to be applicable to Social Security. So here we got $30,000 is his RMD, required distribution, plus $70,000 of Social Security benefits. So we take our $30,000 plus $70,000, we got a little bit of taxable interest, a little bit of dividends. We have over $100,000 of income. But only $25,000 of his Social Security is subject to taxation. That's it. $25,000. Not $70,000, only $25,000. So where his income is actually over $100,000, his gross income, AGI, is only $58,000 because only a third of his Social Security is subject to taxation. I hope this makes sense. Factoring your standard deduction, your personal exemption, which is what this is, his taxable income is only $24,000. They pay $2,300 on over $100,000 of income. $2,300 of taxes on $100,000 of income. That's it. That's it. So he was doing calculations as if 85% of this $70,000 was subject to taxation. 0.85, which would meant $59,000 was subject to taxation as opposed to $25,000. I mean, he's living on $100,000, he and his wife. $2,000 is subject to is taxable. That's it. Tested right here. Basically a Wellesley fund. I'm only giving him 3.8% rate of return. That's it. The target allocation has nothing to do with him. I just showed you. You could go from 3.8 to 5.5, but why? Why? Get a Wellesley fund. 3.8% with a standard deviation of 8.3. That means on any given year, his fund could be down 20%, which is significantly worse than any year that Wellesley ever had. Then when he and his better half die, they're not running out of money because their money's all covered by Social Security for the most part. Not all of it, but pretty much. They're not running out of money. And on top of that, they're leaving downstream $542,000 in today's dollars. In today's dollars, about $1 million in inflated dollars. But that means they spend all this money, they have all this fun, going out, driving, sailing the seas of cheese. having fun, hardly paying any taxes, still leaving over $500,000 of liquid assets to the kiddos. Plus, they still got a house. Plus, they got a camper. Plus, they got a firearm collection. Plus, they got baseball cards. You name it. I mean, it's just such a thing of beauty. I mean, it's literally no risk, hardly. The Social Security is going to basically fully fund their retirement, because Social Security is the predominant amount of income. They don't pay any taxes, or little. When they say no, because people, you're being